Welcome to Municipal Finance for Everyone. Today is September 6, 2025. This is what we are going to cover in this video. The most recent tax-exempt AAA Muni Curve. The most recent tax-equivalent AAA Muni Curve. The daily change of both the AAA Muni and Treasury curves. Their week-to-date change. How the AAA Muni Curve has changed year-to-date. Terms and definitions. Let's go over the most recent composite tax-exempt Muni AAA curve. The following composite tax-exempt yield curve is based off the most recent ICE, TradeWeb, Bloomberg yield curves that are available on the MSRB website, plus some proprietary extra adjustments, as of September 5, 2025. The one-year composite tax-exempt yield is 2.18%. The two-year yield is 2.15%. The three-year yield is 2.16%. The 5-year yield is 2.31%. The 10-year yield is 3.05%. The 20-year yield is 4.03%. The 30-year yield is 4.29%. Let's now go over the most recent composite tax-equivalent Muni AAA yield curve. The following graph shows, in red the tax-exempt after-tax Muni yield curve, versus in blue its tax-equivalent pre-tax version assuming a 40.8% top tax bracket as of September 5, 2025. Why would you care to see the tax-equivalent version of the Muni yield curve? More on this later. Let's first go over the pre-tax, aka tax-equivalent yield curve. The one-year tax-exempt yield is 2.18%, corresponding to a 3.68% tax-equivalent yield for investors in the top tax bracket. The two-year tax-equivalent yield is 3.63%. The 5-year tax-equivalent yield is 3.9%. The 10-year tax-equivalent yield is 5.16%. The 20-year tax-equivalent yield is 6.81%. The 30-year tax-equivalent yield is 7.25%. Let's now go over the tax-equivalent Muni AAA yield curve versus the US Treasury Curve. The reason why investors and financial professionals care about Muni's tax-equivalent yields is to simply have the ability to compare them against US Treasury yields, which are pre-tax yields. Observing the current graph, we can see that currently all the Muni tax-equivalent yields, based off a 40.8% tax rate, are above Treasury yields. When this scenario happens, it may be less convenient for investors to buy US Treasury bonds. For example, if you wanted to buy a 30-year bond, a AAA Muni bond would yield 7.2% compared to a lower yield of 4.8% from a Treasury bond. What if your tax rate, instead of being 40.8%, is for example 27.8%? You may wonder if Muni yields are higher or lower than Treasury yields if you are in a lower tax bracket. As of 2025, single filer earning between $103,000 and $197,000 would fall in this tax bracket. More on tax brackets later. Observing the current graph, we can see there are still some parts of the tax-equivalent Muni curve, displayed in red, currently trading above the Treasury curve, displayed in blue. Back to the tax-exempt version of the Muni curve. Municipal traders and portfolio managers often compare how cheap or rich municipal bonds are versus treasuries by looking at the ratio curve. For each maturity of the curve, we simply compute the ratio between tax-exempt Muni yields and Treasury yields. In general, the closer to 100% a ratio is, the cheaper Muni bonds are. More on ratios at the end of the video. The current one-year ratio is 59%. The 2 years ratio is 61%. The 5 years ratio is 63%. The 10 years ratio is 74%. The 20 years ratio is 89%. The 30 years ratio is 93%. Let's now go over how the Muni AAA tax-exempt curve has changed since the prior business date. The graph displayed on the top-hand side shows the most recent curve versus the prior day curve. The bar plot on the bottom-hand side shows instead the difference between the two curves in basis points. The one-year tenor changed -4 basis points. The 2-year tenor changed -5 basis points. The 5-year tenor changed -7 basis points. The 10-year tenor changed -8 basis points. The 20-year tenor changed -8 basis points. The 30-year tenor changed -8 basis points. Munis and Treasuries daily change. This graph shows how both Munis and Treasury yield curves have changed versus the prior business date. They usually tend to move in the same direction, even though it's not uncommon to see days during which they move in the opposite directions. In general, daily changes between -2 and +2 basis points are quite common. Daily yield changes greater than 5 basis points indicate days with a high level of volatility. Compared to the prior day, Treasury bonds rallied across the curve. As a reminder, when people say that rates rallied, it means Treasury bond prices moved higher. This graph is similar to the previous one, but instead of showing how interest rates have moved versus the prior day, they show how much they have changed since the end of the previous week. The current bar plot shows how Munis and Treasuries have changed since last Friday. Let's now go over how the Muni AAA tax-exempt curve has changed year to date. The graph displayed shows on the top-hand side the most recent AAA Muni curve versus the curve at the end of last year. The bar plot on the bottom-hand side shows instead the difference between the two curves, meaning how much each tenor of the Muni curve has changed in basis points. The 1-year tenor changed -71 basis points. The 2-year tenor changed -71 basis points. The 5-year tenor changed -56 basis points. The 10-year tenor changed 1 basis points. The 20-year tenor changed 42 basis points. The 30-year tenor changed 39 basis points. This graph is similar to the previous one, but instead of showing how interest rates have moved versus the prior day, they show how much they have changed since the end of the previous week. The current bar plot shows how Muni and Treasuries have changed year to date. Terms and definitions. What do we mean with composite? Every day, thousands of Muni bonds are traded, as you can freely see on the EMA website. Different data providers like ICE, Tradeweb, Bloomberg, to name a few, provide their model-implied Muni AAA yield curve. Given that it's very difficult to tell which curve is more accurate on any given date, we compute for every tenor the average off the yield curves available to us, plus some extra adjustments. Currently, we manually capture yield curves and bonds yields available from the EMA MSRB portal. What do we mean with tax-exempt yield? Yield is one way to measure how much return you earn each year when you invest in a bond. Meaning, yield is usually an annualized measure. For example, if you invest $1,000 in a bond with a 5% yield, and it matures in 1 year, you'll get $50 in interest plus your $1,000 back 1 year from now. But most bonds are taxable, meaning you must pay your ordinary income tax on that $50. If you're in the highest tax bracket, currently 40.8%, your after-tax interest actually received would be $50 times 1 minus 40.8%, and that's equal to $29.60. This means your true after-tax yield is 2.96%, not 5%. On the other hand, most, but not all, municipal bonds, aka Munis, are usually tax-exempt at the federal level. That means the full 5% yield from a Muni bond stays in your pocket, no federal tax is taken out. This is very important to keep in mind when comparing municipal bonds that offer a tax-exempt yield versus the yield of taxable securities, like US Treasuries and corporate bonds. What do we mean with tax-equivalent yield? From the previous slide, we know most but not all Muni bonds offer tax-exempt yields. However, in order to fairly compare a Muni bond to a taxable bond like a US Treasury, we need to ask, what taxable yield X would give me the same after-tax yield as the one given by my tax-exempt Muni bond? This X is what is usually called tax-equivalent yield, TEY, and it shows what a taxable bond would need to yield to match the Muni's tax-free return. The formula to compute the tax-equivalent yield is given by Muni, tax-exempt yield divided by 1 minus tax rate. For example, if a Muni bond yields 3%, and you're in the 40.8% tax bracket, the tax equivalent yield would be 3% divided by 1 minus 40.8%, and that's equal to 5.07%. So a taxable bond like a US Treasury would need to yield at least 5.07% to match the yield of a tax-exempt Muni bond, currently yielding 3%. What do we mean with basis points? This term is often used by financial professionals. However, it's a very easy concept, don't be scared about it. Let's break it down. Basically, 1% is equivalent to 100 basis points. This means that when you hear someone saying interest rates increased by 100 basis points, that means they increased by 1%. If 1% is equivalent to 100 basis points, then 0.01% is equivalent to 1 basis point. For example, if the yield of a Muni bond changes from 4.00% to 4.01%, it's simply easier to say the yield increased by 1 basis point, instead of saying the yield increased by 0.01%. That's it. What do we mean with Muni-Treasury ratios, and why are they important? First off, ratios are computed for each tenor of the curve. This means we compute the 1-year ratio by dividing the 1-year tax-exempt Muni yield by the 1-year Treasury yield. Same thing for the 2 years ratio, 5-year ratio, etc. Why do we compute ratios? They are one way portfolio managers and traders use to measure the relative value between municipal bonds and treasuries. Treasuries are the risk-free benchmark, backed by US government. Munis are obligations issued mostly by states and cities. Therefore, professionals want to know, am I getting enough extra yield in munis compared to risk-free treasuries? If, for example, the 30-year ratio is 100%, that means the 30-year tax-exempt Muni yield is the same as the 30-year Treasury yield. However, the Treasury yield is taxed, whereas the Muni yield usually is not. Hence, in this case, you'd be better off holding a Muni bond. In general, if the ratio is below 100%, one may think munis are rich compared to treasuries. In reality, we should always wonder, how does the current ratio look like compared to its own history? What's the average ratio over the past year? Let's make an example. You will notice from the data that usually the 1-year ratio tends to be between 60% and 65%. Hence, if the current 1-year ratio is, for example, 70%, even if this value is less than 100%, the current value would still be quite high compared to its historical average. For this reason, one may conclude 1-year Muni bonds are currently trading cheap.